What do you make of what's going on in China this morning? And some of the China stocks are just getting whacked. And what that really means is China going after companies that have too much power? Are these, by the way, people have questions about some of the accounting of these companies in China? Is that what's happening? They're trying to...
I think these are very serious violations that make us realize that capitalism is not alive in China. And we kidded ourselves that we thought that the party was somehow going to want to join the rest of the world in being capitalistic. They're not. This is a dictatorship, and we're beginning to wonder. I question every one of those companies that's on that list. Any one of them could be vulnerable. It's time. You got to go. You can't own these stocks.
Chinese stocks have taken a massive hit in 2021. Just over in 2020, Alibaba was the darling of the Chinese stock market. And if you hadn't been one of those early investors that had invested in Alibaba, you had technically missed the boat. But over the past year, Alibaba and some of its other tech rivals have taken massive hits, as high as 40% from their peak in 2020 from a stock price perspective. So in this video, I'm going to be talking about what is the actual risk of owning Chinese stocks like Alibaba that no one is talking about. Hello and welcome to The Nimble Nomad. My name is Arjun and this is the channel where we talk about money and investing.
What are they going to do with Alibaba? Is Alibaba okay? They have American financials. It's always been transparent. Or is Alibaba just another company that they think the rich people have benefited from? So I think this is an attack on the rich, and it's an attack on people who are creating content that is not becoming of the Chinese Communist Party.
Chinese stocks have been absolutely getting crushed in 2021. And for example, Alibaba, which was at its peak in 2020, has taken nearly a 40% correction from that peak in just this past year. So what is the actual reason for this? Now, the press and a lot of YouTubers are citing some of the Chinese government's regulation and crackdown. And yes, although this has a part to play, but there is another element which comes into play which nobody is actually talking about, and that is associated with three simple letters called VIE.
You can't own these stocks. It's almost irresponsible as a fund manager to. When the people tell me they're cheap, I said, how do you know that? What are you valuing? You own a VIE structure, period.
If you've never heard of the term VIE associated with Chinese stocks which are listed in the US, don't worry, I hadn't recently. VIE actually stands for Variable Interest Entities, and it basically is associated with the ownership structure that these Chinese companies involved when they list on the US stock exchange, and it's used by all of the major players such as JD, Tencent and Alibaba, to name a few. So what is a VIE? So basically the Chinese government limits foreign nationals being able to own companies that manage and handle critical national infrastructure and sensitive data that belongs to Chinese citizens. And this includes technology companies like Alibaba, Tencent and Baidu. Now, in order to get around this, basically what these companies have done is build a loophole, which includes building a variable interest entity, or rather a holding company, which is actually based out offshore on the Cayman Islands, for example. And basically these holding companies are what are actually listed on the US stock exchange. So when you buy a share or the American Depository share, so ADS, on the US stock exchange for a Chinese company, you're actually buying a piece of this holding company which is listed in Cayman Islands. So for example, for Alibaba, you would be buying Alibaba Group Holding Company, which is listed in the Cayman, and this company actually doesn't have any employees, a physical office, or any actual direct correlation with the Chinese company or the Chinese version of the Alibaba. So the way it actually works is this group holding company, through a legal structure or a series of legal agreements, indirectly gives Western shareholders access to the Chinese version of Alibaba, and that's how people end up owning that Chinese company. Now, why is this actually a risk? So the main risk with this is essentially the fact that the Chinese government does not recognize this whole structure of VIEs or variable interest entities. As a matter of fact, the Chinese government actually thinks this is illegal. But like all laws that exist in China, this is one of those laws which has not typically been acted upon. But there is a massive risk in light of what has been happening in China that the regulator and the Chinese courts could at any point enact this law, making ownership of foreign nationals of these group holding companies null and void. So even though these legal agreements between the two companies entitle you to have access to the original company that's listed in China, in Chinese law, basically this is not recognized. So if ever there was a dispute that were to arise between investors and the group company for whatever reason, basically this group holding company, which acts as an intermediary, could just disappear and you would not have access or any rights on the business that you actually own. Okay, so should you buy any of these US listed Chinese stocks? Now, ultimately, China has some really wonderful businesses with really strong fundamentals and foundations. Now, if you believe the numbers that these companies are actually reporting, some of these stocks actually have massive growth potentials. And in my opinion, although there is always this risk that the Chinese government may enact its own law and make this whole VIE ownership structure null and void, I think the risk of this actually materializing is quite low. So although the impact, if they were to enact this, would be significant in that any Westerner who owned these stocks would basically just have nothing in their hands overnight, I think the likelihood of this actually happening is really low. And the reason for this is by doing this basically. So if China decided to enact this, they would actually be strangling their own economy. They would be cutting off significant proportions of foreign investment and funding into their economy, which would basically limit growth going forward. I don't think that is something that the Chinese government wants. And some of these companies are actually huge players which will enact and enable China to become one of the largest economies by 2030. So in my opinion, I definitely think there is a risk, but it's worth considering if you want to look at some of these stocks. So I did go ahead and buy Alibaba last week because I felt like the valuation had gotten so low because of the panic on the streets with what's happening in China and the Chinese regulator and this whole ownership structure, that I jumped in and I bought a little bit of Alibaba. Now, obviously, I do want to clarify that this is my own portfolio and what I'm doing with my money, I'm just sharing it with you. And the thing to keep in mind is this is one of my highest risk and calculated speculative plays within my portfolio. So it is not a major position within my portfolio. It is a small proportion. And I think to a certain degree, I'm okay with losing this money should something go drastically wrong. I hope this video helped you out. If it did, please smash that like button and don't forget to subscribe. And I shall see you in the next video. Goodbye.